Does it really matter whether you own investment property personally or through a limited company? Well, depending on your investment goals, yes it does. And in the next few minutes, I'll explain why. I'm James Poyser. I'm the CEO here at Provestor, the property accountants, and we're here to help you with all things property tax. Investing in property is much tougher than it used to be. Increased regulation, stamp duty changes, and decreasing tax relief means many landlords who own property personally have seen a reduction in their rental income. To counter these difficulties, more and more investors are deciding to buy properties through a limited company. This is sometimes called a property investment company, or SPV, which stands for Special Purpose Vehicle. This option is so popular that 77% of buy-to-let properties are now purchased through limited companies. This massive increase in property investment companies is mostly due to the different treatments in taxation. Instead of paying income tax as an individual, a limited company pays corporation tax. This makes a big difference to higher and additional rate taxpayers. Running your own property investment company won't be for everybody, but if you're thinking of investing in a buy-to-let, it's an important option to consider. Getting your business structure right at the start could make a big difference to the amount of tax you'll be paying. So what are the tax differences between personally owned and limited company owned properties? Let's start by taking a general look at how profits are calculated for tax purposes. As you can see, this is fairly straightforward. You deduct your allowable expenses from your rental income to arrive at the profit, and this is the amount you pay tax on. Income is the rent that you receive each month from tenants. Your expenses could be interest from your buy-to-let mortgage, which we'll talk about in a moment, utility bills, service charges, letting agent fees, and general maintenance. Tax is then paid on the amount of profit that remains after your expenses have been deducted. If you own properties personally, you'll pay income tax at your normal rate on your profits, be that 20%, 40%, or 45% for basic, higher, and additional rate taxpayers, respectively. It's worth mentioning at this point that as an expense, your buy-to-let mortgage is treated quite differently depending on whether you own your investment properties personally or through a limited company. And this is the point where many landlords start to consider using limited companies. Let me explain why. Here's a simple example. Let's say that you have a property that you rent for £1,000 per month and your mortgage interest is £500 per month. We'll keep it simple and ignore any other expenses. If you're a basic rate taxpayer and own the property personally, it's straightforward. You can deduct your mortgage costs and pay income tax at 20%, which is £100. This leaves £400 of profit after tax. It's also straightforward if the property is owned via a limited company. You can deduct your mortgage costs and you'll pay corporation tax at 19%, which is £95, leaving £405 after tax. However, if you're a higher rate taxpayer and own the property personally, your tax bill will be significantly higher. The calculation is more complex, but the end result is that you'll pay income tax of £300, giving profits after tax of just £200. This additional tax burden on higher rate taxpayers is due to a piece of legislation called Section 24, which was introduced in 2015 to slow down the private rental market. But there's also more bad news. When you own a property personally, you may find yourself moving up into higher tax bands over time. Perhaps your portfolio is booming, or you get a promotion at work and your income increases. This means your buy-to-let could suddenly become unprofitable. And it gets worse. If your total income from employment and your properties tips over £100,000 per year, you'll start to lose your tax-free allowance, you'll pay tax at 45%, and if you have kids at nursery, you'll start to lose your 30 hours of free childcare. Ultimately, Section 24 makes being a landlord much less financially rewarding if you own your property personally, which explains why limited companies are now so popular. This feels like a good point to explain how limited companies work in more detail. Before we continue, I just want to call out some free resources that you might find useful. Head to the description below and you'll find links to our expert guides, calculators and fact sheets, all of which are freely available on the Provestor website. Check them out and let us know in the comments if you found them useful. Tax on properties owned via limited companies is quite different and far more flexible. As you've seen, limited companies pay corporation tax on profits, which is currently 19%. Compare this to high-rate taxpayers who pay tax at 40%, and you can see straight away that high-rate taxpayers are often better off investing via limited companies. Once you've paid your corporation tax, if you keep the profit inside the company, perhaps to save for another property, then there's no more tax to pay. If you want to take profit out of your company and pay yourself personally, there are three main ways to do this: salary, dividends, and pension payments. Each one is taxed differently. Now, this might sound complex, but it's this flexibility that is often the appeal of limited companies. For example, if you're growing your portfolio, you might keep all the profits in the company to buy your next investment. If you're looking for passive income in the future, you might start paying out the profit you've saved via tax-efficient dividends. Or if you're a saver, you might pay the profits into a pension fund and take advantage of the tax incentives here. Overall, take the time to weigh up all the pros and cons and chat to an expert before deciding whether owning investment property personally or through a limited company works best for you and your goals. If you're thinking about investing and need some expert tax advice, why not book a 45-minute consultation with one of our accountants? Click on the link above to find out more. Thank you for watching this video. I hope it has been a useful overview of the tax differences between personally owned and limited company owned properties. If you found this useful, please like this video, subscribe to our channel, and if you have any questions, drop a comment below. I hope you've enjoyed this video, and I'll see you in the next one.